Good day. Welcome to the part 2 of our lesson on income tax, IAS 12. Now, over here, the most important thing that we are going to talk about is about the recognition of tax as amounts for the period. So, tax amount or tax expense to recognize in the statement of profit or loss. That is the most important thing we are going to talk about. Afterwards, I'll talk about one or two things about where to present, where to recognize deferred taxes and some of these other taxes in the financial statement. But let me say this. We know that in preparing published financial statements, okay, in preparing published accounts, we need a tax expense because the format says that in a company, typical company account setting, we have operating profit. That's the net profit before interest and tax. We take out the finance charge as interest. Then we have the net profit before tax. Then we take out tax expense in order to get the net profit after tax. Now, that tax expense is what we are going to talk about because most of the time, that is why I needed to do this standard before I treat the published accounts. And that is why I'm doing it. Now, the tax expense, how do we estimate the tax expense? The tax expense to recognize is not the current tax that will be given to you. So there will be a current tax for the year. That is the tax that is estimated for the year for you. That is not what we are talking about. So if you have your current tax, the current tax is not the only tax that you are going to recognize in the profit or loss statement. Now, the tax expense to recognize, I'm giving you this formula. Watch carefully. The tax expense to recognize is your current tax plus your movement in deferred tax. I repeat, the tax expense to recognize is your current tax plus movement in deferred tax. What do I mean by movement in deferred tax? Movement in deferred tax is, the same idea of allowance for receivables or provision for doubtful debt. We know that we have previous years. If you have previous years provision, the same with the deferred tax. If you have, let's say, provision in the trial balance, you have deferred tax in the trial balance as maybe 1,000. If there is a deferred tax in the trial balance, credit side, okay, now watch carefully. If you have deferred tax on the credit side like this, 10,000, and in the additional information, you are given a temporary difference to calculate deferred tax. Sometimes you'll be given a temporary difference, and then based on that temporary difference, you calculate your deferred tax. So let's assume you calculate your deferred tax liability, and you are getting the deferred tax liability to be 1,500 at the end of the year. Now, whatever deferred tax you have in the trial balance relates to last year. Just like provision for doubtful debt, we compare and take the difference. And so, if deferred tax liability from last year in the trial balance is 1,000, and this year you are getting a deferred tax liability for 1,500, then the movement is 500. So, if the question gave you a current tax of, let's say, 800 as your current tax for the year, then your tax expense, or when you are preparing your statement of profit or loss, when you get to net profit before tax, the tax you are going to write there will not be the current tax of 800, will not be any of it, but it's going to be the 800, which is the current tax, plus the movement. What is the movement? The movement in deferred tax is 500. That is an increase in the provision for deferred tax. So it's 500. And so you are going to recognize 1,300 as your tax expense. That is when it's a liability. Okay, let me deal with the tax liability movement. Afterwards, I'll deal with the tax asset movement. And so this is a tax liability. That is why the deferred tax is on the credit side. And so when you have a deferred tax liability, and then a closing deferred tax liability, you compare and take the difference. If it is an increase, you add it to the current tax that will be given. That is the provision for tax that will be given for the year, okay, which should have been an expense. You put that there as 800, and then the movement in deferred tax, you add that, and that is going to give you 1,300. Assuming that the deferred tax for this current year was, let's say, 800 or 700 Ghana cedis. Then it means that last year's deferred tax liability was 1,000. This year's deferred tax liability is 700. The movement is 300, but it's negative. It's a decrease of 300. And so your tax expense to recognize for the year would have been your current tax, which is 800, plus the movement. This time, the movement is negative. So it's going to be minus 300. And that means that you're going to recognize 500 as your tax expense for the year. Please pay attention to this very well, because in preparing published financial statements, a lot of us find it difficult on how to recognize these tax expenses. And that is why I'm saying that you'll be given a deferred tax, or sorry, you'll be given a current tax provision for the year. I'm going to talk about the prior year adjustment on current tax as well at the end of this video. But for now, my focus is on how to deal with the movement in deferred tax. And so if you have a deferred tax liability from last year and then a deferred tax liability from this year, you compare and take the difference. If it is an increase, you add it to the current tax to ascertain your tax expense for the year. If it is a decrease, you subtract from the current tax to ascertain your tax. So it means that when you are preparing your statement of profit or loss and you get to the net profit before tax, where you have to charge tax, you are going to charge this 500. That is the meaning. So whatever current tax will be affected by movement in deferred tax. Now let us also assume that this deferred tax was an asset. So let's change the scenario. So the current tax remains 800 in the additional information, but we have a deferred tax of 1,000. Now the deferred tax is now on the debit side. It means that it's a deferred tax asset. So if you get a deferred tax asset and then you calculate year-end deferred tax, and that also becomes an asset, okay, an asset of, let's say, 1,500, then it means that the movement in deferred tax is 500, but it will be a negative movement. Even though it's positive, because it is an asset, the increase in an asset will rather be subtracted. So you see that, let me do this analysis. If deferred tax, if it's liability, then under liability, increase in deferred tax liability will be added to the current tax. A decrease in deferred tax will be subtracted. The opposite is true for asset. If it is a deferred tax asset, an increase rather will be negative, so we subtract. Please pay attention to these things very well. And then a decrease rather will be added. And so in this case, it's an increase. But because both of them are deferred tax assets, an increase in deferred tax will be negative. And therefore, we are rather going to subtract 500, which is the difference from the current tax. And therefore, our tax expense for the year will be 300. Please and please again, you need to understand this very well. Other than that, you can never solve questions on published accounts. It's very, very important that you understand the fact that your tax expense to recognize for the year is your current tax plus your movement in deferred tax. And it depends on whatever movement that you have. If the movement is such that an asset is increasing, then you subtract. So we subtract increase in asset and decrease in liability. Then we add increase in tax liability, and then we also add a decrease in an asset. So assuming that the asset was decreasing to, let's say, 800, then the movement is 200. But because it's a decrease, we are rather going to add the 200, and it's going to make our tax expense to be 1,000. I am sure this is very understandable. We need to understand this very, very well. Okay. Okay, so let us look at another scenario that in case we have a deferred tax, okay, a liability of, let's say, 400. And in the additional information, there is a current tax. As for the current tax, it's the tax for the year. So let's say current tax of 1,000. And then we have a deferred tax. This time, the temporary difference, we have a liability from the beginning. But we calculate and we get a deferred tax asset of, let's say, 200. Now, let's compare the movement, okay? Current tax is 1,000. We need the movement in deferred tax. That is the headache now. The opening balance was 400. If you look at it straightforward, you may say that the difference is 200. And then you go and you will be wrong. Because one is a liability, this is an asset. So they are not the same. So before a liability drops into an asset, it's like saying 400 minus 200. So that the difference will be 600. Please, I don't know how you understood what I'm trying to say, but we are trying to say that the liability dropped up to 0 before the asset started accumulating up to 200. So the movement is actually 600. And it's a reduction in liability and an increase in an asset. And we all know that a reduction in a liability is subtracted, increase in asset is also subtracted. So they have the same effect. So the moment you see that the opening liability was 400, but it has gone down to the point where it has become an asset. So the difference actually is 600. And it should be subtracted, so it will be minus 600. So the tax expense for the year will be 400. Ladies and gentlemen, if you don't know how to estimate these things, if you get final account for publication and you get to additional information for tax, you can't do it. Please, it's very, very important. That is why I left the part 2 of this IAS 12 only to explain these things, because it's very, very important. Okay, so it is 400. It's like, okay, let's say it's a liability. So it's negative 400. And then you are subtracting, you are comparing. Okay, you are comparing. So negative 400 minus 200 again. So that is going to give you negative 600. So please, you really, really need to understand the dynamics of this movement very, very well. Let us also look at the case where we started from an asset and ended up at a liability. So let's assume that this time the opening balance was an asset of 300. Deferred tax asset of 300, and then we ended up at a deferred tax liability of, let's say, 200. Now let's look at the movement. If you look straight, you may think it's 100, but this time the asset has increased. You know, liability increases. The deferred tax increasing is a liability, it decreases into assets. Okay, so down to 0 and then up to 200. So it is like a number line from 300 to 200, 200, then 0, then 100, 200, from the asset side to the liability side. If you look, it is 1, 2, 3, 4, 5. So it's 500. So if you look at it straight away like this, you may think the movement is just 100. But starting from an asset and becoming a liability, the movement in deferred tax is a positive 500. And therefore, we are going to have 500, which is going to make our tax expense for the year to be 1,500. All these things that I'm teaching you is very, very important, because in as much as you can be examined on it straight, in IAS 12, we can give you a question that is, you know, this kind of questions come with advice. So they'll give you a question and say, advise the company on how to treat the deferred tax, or how to or calculate the tax expense to be recognized in the profit or loss. So you need to go through this, get the movement in deferred tax, add to the current tax before you are able to estimate your tax expense for the year. So that is not all. There is one more thing to talk about before we finish with these estimations, is that now that we've understood the movement in deferred tax, let us also talk about the current tax itself. So I'm going to clean this side to talk about the current tax itself. Now, what you have to understand is that the current tax itself could also be adjusted with prior year taxation. Now, you could have in the trial balance current tax, just as you have deferred tax. Okay, deferred tax could be an asset or liability, like I have explained. I'm done with the explanation of the movement in deferred tax. Let us also talk about the current tax. In as much as when you come to the additional information, under the information on tax, you have current tax to be, let's say, 1,000. And then they also give you the deferred tax. As for the deferred tax, it could be a temporary difference in the rate that you apply, okay? But we have dealt with the deferred tax issues. So let us focus on how to adjust the current tax. Now, you have current tax could be on the debit side to be 200, or on the credit side. Now, whatever current tax that is in the trial balance is coming from it last year. Now, listen very carefully. The current tax that is in additional information is just a provision. It's an estimate. It is not the actual tax. It's just an estimated tax assessment that you have been assessed. So we are saying, okay, we are estimating that this year, this is the tax you are supposed to pay. So this 1,000 current tax, or the current tax that I'm talking about, it's not actually the tax, but it's just an assessment a provision of an assessment. So what we are trying to say is that we have made provision for you. So it could be under provided or over provided. So that could be, they could be over provision or under provision based on the circumstance, and it will not be known until next year. So whatever current tax you have in your trial balance could represent an over provision or an under provision from the previous year. If the current tax appears on the debit side like this, then it means that this is an under provision. This is an under provision from the previous year. Okay, so you still need to pay this, and so you adjust that. And so when you are finding your tax expense, this 1,000 needs to be adjusted with this 200. It's an under provision, meaning that we undercharged you last year, and so it's going to be this 1,000 plus the 2,000, and that is going to give you a current tax of 1,002. So before you even talk about your movement in deferred tax, you need to adjust any over or under provision of current tax from the previous year. And so if it is on the debit side, it's an under provision. If it is on the credit side, it's an over provision. Over provision means that we have overcharged you last year. So sorry, we are now giving to you as a tax credit. So it will reduce your current tax. So any over provision on the credit side will reduce your current tax to 800. And so let me give you a final summary of what I'm talking about. Now, so your tax expense to be recognized is actually your net current tax plus movement in deferred tax. And what do I mean by net current tax? The net current tax is your current tax, okay, current tax plus or minus over or under provision. So current tax, if there was any over provision, you subtract it. So current tax plus under provision. And under provision is found on the debit side. And then you subtract over provision. Over provision is found on the credit side. And so what we are trying to say is that before you get the net current tax, you need to factor your current tax and then make any adjustment for the current tax. So if you see any current tax in the trial balance, it refers to over or under provision from the previous year. And you need to, if it is a credit balance, it's an over provision, you subtract from the current tax before you get the net current tax. If it is a debit balance, it's an under provision. You add to the current tax before you get the net current tax. So to get your net tax expense for the period, you need to estimate your net current tax by adjusting for under or over provision of tax first. Then you go and look for your movement in deferred tax as another working. Adjust that as well. And when you have added the two, you have your tax expense for the year. So the tax expense on the statement of profit or loss is not something that you come about very easy. Okay, you need to work for it. And that is why you need to understand the IAS 12 very well in order to estimate the tax expense to recognize. And this is how the question will come, that they can give you all this information in a IAS 12 typical question understanders, and they tell you to estimate the total tax expense to be recognized in the statement of profit or loss. And you have to go through these formulas in order to arrive at that. And afterwards, you advise the company. But when you are preparing published account, you use the same approach in order to estimate your tax expense for the year. Okay. Now, at this point, the only thing left to talk about with the IAS 12 is a presentation of the deferred taxes and then the current tax payable on the financial statement and then the disclosure requirement. So I'm going to end here on this so that you have time to meditate on this. If there should be another video which I'll do on the IAS 12, I'm going to talk about the other areas that I have not spoken about. But I feel that I have spoken about the more important areas that you need to understand some other aspects of your published account and also to be able to pass questions on IAS 12. Remember to subscribe to this channel if this is your first time. Share this video and let others also have a benefit. And until we meet again another time for another video, it is bye for now. Thank you.